my name's Nico. I'm making this video for my investing, trading, and startup Facebook group. I've reached out to a number of you, thanking you for joining the group and asking you for any input on what kind of things you want to know, what things might be helpful. And it became apparent that a lot of people are complete beginners, and it made me think that, okay, let's hit the fundamentals of asset management, personal asset management. We're going to do this video in about 5 minutes because I'm going to trade in about 10. So here we go. Take a look at my board here. I have got this board is showing you just the basic roadmap of asset management. So the foundation, I'm originally a real estate guy. I did a lot of real estate stuff in Japan. Many of you know me from that. So the foundation of any asset management structure is insurance. If you have somebody who relies upon you for any kind of income, you need to have a term life insurance policy. Do not get an insurance-based savings plan. They're a ripoff. Finished. Okay, so insurance is also like health insurance and car insurance and homeowners insurance. The insurance policies are not an investment, but they protect you against a catastrophic loss so that you don't have to pay your own hard-earned money to take care of some sort of liability that you incur. All right, next. The first floor is everybody should have about 3 to 6 months. COVID has taught us this. Everybody should have about 3 to 6 months of cash reserves just to handle your expenses. Businesses should have this. Individuals should have this, okay? If you don't have this, it doesn't mean you can't start other investments, but it means that you should be working on building this while investing elsewhere, right? The next floor up is monthly savings plans, some sort of portfolio, some sort of group of funds. I like index funds, right? Some sort of group of funds that is going to mitigate your risk by being invested in shares of companies across multiple funds, across multiple industries. And this way, you're going to have a pretty secure investment in this kind of monthly savings plan kind of idea here, all right? Monthly savings plan. Okay, a lump sum investment is different. Back to the monthly savings plan, we use a technique where we're buying every month, and it's called monthly, dollar cost average. Dollar cost averaging, okay? And dollar cost averaging means that, my cost per purchase changes each month, but my average over time is going to be much lower because I'm going to buy in the dips, I'm going to buy at the peaks, just going to keep on buying every month at my set time. And over time, over a 20 to 30-year life of a monthly savings plan, I'm going to have a better price than I would have otherwise. Okay, lump sums don't work that way. This is the next risk level up. So each time we get higher, we see that we're getting more and more risk the higher we go. There's more and more risk. There's also more and more reward, okay? So the idea with a lump sum is that you're going to purchase a stock or a bond or something just one time. You're going to put an extra $1,000, $2,000, $10,000, euros, whatever, into a fund or into a stock, and just let it ride there because you feel that over the long term, based on fundamental analysis, that this is going to turn into a more valuable instrument in the future, right? So yeah, like I'm telling you, risk goes up. All right, with each one of these. So okay, the riskiest thing we can do is to own our own business, right? This is the riskiest thing we can do with our money. And, this includes trading, because if you're not trading, you're trading like a business, you're doing it wrong, okay? Business or trading, these are the riskiest things you can do with your money. And you don't want to be doing any of these things unless the risk is mitigated by other investments below, right? So the whole idea of asset management is you step by step build your assets up so that the risk of the higher activities, higher risk activities, is mitigated by the security of lower risk assets, right? Now, one thing that's right in the middle between the lump sum investment and the owning your own business is startup investing. Excuse me, startup. Okay, so startup investing is less risky than running your own business with your money or trading, but it's riskier than a lump sum because startups have a higher likelihood, a higher incidence of failure than, say, other established businesses that you might buy stocks in, other bond funds. You don't typically fail. Those stocks and bonds, though, in the lump sum level can get halted, and you can get your money trapped in those instruments while there's some sort of legal dispute about some company that's held inside it. That can happen also in here, right? So there are risks that are involved, but they are not as risky as the higher startup investing and the business or trading investing can be. So here's a roadmap to asset management and a roadmap to building your assets. If you have any questions about these things specifically, get back to me and we'll get you more information on those. Thanks. I'm going to get trading here. We'll catch you next time. Goodbye.